Hey everyone, welcome back to Corporate Decoder, the place where we decode the deepest financial secrets hidden in those super long SEC filings. And today we are diving into Regency Centers Corporation's latest 10K report. Get ready because we are about to unpack how this real estate giant is really doing beyond the gloss and buzzwords. And hey, if you love getting these kinds of straight shooting insights from corporate filings, make sure you are subscribed so you don't miss out. We also have a thriving community over on Discord where we break down these reports even further, so hop in via the link in the description. Alright, so Regency Centers Corporation and its subsidiary Regency Centers LP have put out their annual report. Think of this as their yearly checkup with the stock market, telling everyone how business went in 2025. They are in the business of owning shopping centers, those neighborhood spots anchored by grocery stores, basically places where you go for everyday needs. As of the end of 2025, they own part or all of 481 properties, around 58.4 million square feet of space. That is a lot of retail real estate, and it is spread across the US, mostly in suburban areas. Their mission sounds pretty noble, creating thriving environments for businesses and communities. Their vision is all about elevating quality of life. In simpler terms, they want to own the cool shopping centers that everyone likes to go to. Now let's talk about the big picture risks. The report mentions global economic and political stuff as a major risk. Things like government policies, interest rates, and even international conflicts, they all play a part in how consumers spend money and how well businesses in their centers do. If people get nervous about the economy as a whole, or if trade becomes more difficult, it can directly hurt their tenants. And when tenants struggle to pay rent, it hurts Regency Centers too. Interest rates are a big deal for any company that borrows money. They mention that if interest rates go up significantly, it will cost them more to borrow money or refinance existing loans. This could mean less profit and make it harder to raise money for new projects. They also point out that higher interest rates can make their stock less attractive to investors. You guessed it, pandemics are still on their radar as a risk. While most of their income comes from long-term leases, they acknowledge that a big health crisis could still impact their tenants' ability to pay rent. This might be one of the most important points for Regency Centers. They face the reality that shopping is changing. E-commerce, online shopping, home delivery, all of it impacts their tenants. While grocery stores are still a strong anchor, they highlight that retailers big and small are adapting, and this can affect the demand for physical store space. A huge part of their business model relies on those big anchor tenants like grocery stores. If a major tenant leaves, goes bankrupt, or downsizes, it can really hurt the whole shopping center. These anchors bring shoppers in, which helps all the smaller stores too. Now for the numbers, in 2025, Regency Centers brought in $1.55 billion in total revenues, up from $1.45 billion in 2024. A lot of that increase comes from base rent, which went up by $62.8 million. This growth in base rent is a good sign. Recoveries from tenants jumped by $31.1 million. This means their tenants are paying more towards things like operating your typical property expenses. This is good because it shows tenants are doing okay and the properties are likely more occupied. On the flip side, their property operating expenses also went up by $16.2 million. This is mainly because of higher common area maintenance, utility, and management costs. It seems like keeping these centers running is getting more expensive. So what does all this mean for the bottom line? Net income attributable to common shareholders was $513.8 million in 2025. That is up from $386.7 million in 2024. That seems like a big jump, and it is partly thanks to a $72.2 million gain from distributing some properties to partners. Their core business from existing properties also grew. When you look at their pro rata same property net operating income excluding termination fees, that grew by 5.3%. This is a key measure of how well their existing properties are performing, and that growth is solid. It means rents are up and they are managing expenses. Now let's look at funds from operations, which is a big number for REITs. Their NAREIT FAFO attributable to common stock and unit holders was $855.7 million in 2025. That is up from $790.8 million in 2024. This shows their operating performance is strong. And what about adjusted funds from operations, or AFO? That one is $706.6 million, up from $649.3 million. This is a better measure of cash available for dividends after accounting for necessary property upkeep. Here again we see a risk factor. They mention that if their properties cannot generate enough NOI, or if market capitalization rates go up, it could hurt their ability to sell properties. Selling properties is how they raise money for new projects, so this is a potential constraint on their growth. Looking at their stock and compensation plans, the report details their equity compensation. They have various awards including restricted stock and performance-based awards. The key thing here is that they have millions of shares potentially available for future issuance, and this can dilute existing shareholders if not managed carefully. Let's check out the balance sheet. As of the 31st of December 2025, total assets were $13 billion, up from $12.39 billion the year before. That growth comes mainly from their real estate investments, which are now valued at over $11.2 billion. Their debt is also substantial, hitting $5.8 billion in total liabilities. So going back to the profit, net income attributable to common shareholders was $513 million. This is a good number, but when you factor in the $72 million gain from that distribution, it means the core business growth was actually closer to $55 million. Still positive, their strategy of focusing on high-quality grocery-anchored centers seems to be working for them, especially those in strong demographic areas. However, they face risks from changing retail trends, rising expenses, and interest rate hikes. The company is performing well financially, but investors should keep an eye on how they manage their debt and how they adapt to the evolving retail landscape. Alright, that is our deep dive into Regency Center's latest filing. What a journey through Real Estate Number's risks and strategies. What do you think about their performance and their outlook for the future? Let me know in the comments below. If you found this breakdown helpful, hit that like button to show your support and subscribe for more regular corporate deep dives. Also, don't forget to join our Discord community through the link in the description where we dissect these filings further. Thanks for watching, and we'll see you in the next one.